Welcome back to the Deep Dive. Today, we are opening a file that, honestly, it feels a little bit like we're reading a script for a financial thriller movie.
Oh, absolutely.
But fortunately, depending on how your portfolio is set up right now, this is real life. We are talking about gold. And I don't mean, gold like the ring on your finger. I mean gold as the canary in the coal mine for the entire global economy.
It is a massive topic. Usually, gold is the boring asset.
Right.
It sits in a vault, it collects dust, it doesn't pay dividends. But right now, the data we are looking at for 2026 suggests that this boring rock is at the center of a perfect storm.
Exactly. So let's set the stage for you listening at home. Right now, in early 2026, gold is hovering around $3,000 an ounce.
Yep.
And to the average person walking down the street, that sounds expensive. It feels like a high watermark.
Yeah.
But we have a stack of reports here today from major Wall Street institutions. We're talking JP Morgan, UBS, Bank of America.
With heavy hitters.
Right. And they are basically saying you ain't seen nothing yet.
That's the hook right there. We are seeing serious institutional discussions about gold hitting $6,000. And there are even credible models.
Mathematical models. Right.
Yes, mathematical models pointing toward $7,300 an ounce.
7,300. I just want to pause on that for a second. That is more than double where we are used to seeing it. So the mission for this deep dive is to answer a very expensive question for you. Is the financial system entering a new supercycle where commodities just keep going up forever?
Or is this a massive bubble waiting to pop?
Exactly. And the stakes couldn't be higher.
They really couldn't. We aren't just talking about making a quick buck on a trade. When we talk about a gold shock of this magnitude, gold is acting as a proxy. It's a thermometer.
That's measuring the fever.
Exactly.
Okay.
It measures the health of the U.S. dollar, the stability of the debt ceiling, and frankly, global trust in the traditional financial system. If gold goes to 7,000, it tells us something is fundamentally broken in the engine room of the economy.
So we have a lot to get through today. We're going to break this down into three main areas. First, the Wall Street split, because the experts are actually fighting about this. Second, the 5 secret drivers pushing these prices up. We're talking debt, the Fed, geopolitics.
All the big macro factors.
Right. And finally, and I think most importantly for anyone listening, the wealth defense strategy. If this scenario plays out, where do you actually put your money in 2026 so you don't get wiped out?
I like that roadmap. Let's get into it.
Okay, let's start with the Wall Street split. Usually, big banks like to herd together.
Oh, yeah. Safety and numbers.
They all predict roughly the same thing, so no one looks stupid alone.
Yeah.
But here, looking at these reports, the gap is wide. It's a canyon.
It really is a canyon. On one side, you have the bulls, the optimists. They are looking at the macro data and they see a rocket ship. Take JP Morgan Chase. They are predicting gold could hit $6,300 by the end of 2026.
$6,300. That's a very bold call for a conservative bank.
And they aren't the only ones. UBS is targeting $6,200 by mid-2026. Bank of America is looking at a range of $5,000 to $6,000, assuming investment demand holds up.
So they see a fundamental shift in how money is moving around the globe.
They do, but then there is this extreme case that we flagged in our research notes, the technical analysis side of things.
Now, this sounds a bit like voodoo to me. Can you walk us through it?
It's not voodoo, I promise. It's math. Specifically, it's about crowd psychology mapped onto charts. The report mentions Fibonacci extensions.
Right.
And without getting too deep into the weeds, these are ratios that traders use to predict how far a price can stretch based on previous moves. If the current trajectory holds, that mathematical model points to a staggering $7,200 to $7,300.
That is just wild. It sounds almost impossible until you realize that if enough algorithms and quantitative funds believe it,
they can make it happen. Self-fulfilling prophecies are very real in modern finance. But we do have to look at the other side, the bears, because not everyone on Wall Street is buying this apocalypse narrative.
Right. Who is the voice of reason here?
Morgan Stanley is taking a much more cautious view. They are anchoring their expectations closer to $4,800.
Okay, but let's be real for a second. 4,800 is still incredibly high compared to historical averages.
It is.
But it is a far cry from 7,300.
Exactly. And what's fascinating here is what that gap represents. When you have a spread that wide, from 4,800 to 7,300, it tells you there's deep structural uncertainty among the smartest people in the room.
Nobody actually knows what's going to happen.
Exactly. One side sees a structural collapse of trust in fiat currency. The other side just sees a short-term psychological spike that will eventually level off.
So let's dig into the why. If JP Morgan and the bulls are right, what is the fuel for this rocket ship? We identified 5 specific drivers in the source material. Let's start with the big, ugly one, the debt.
Driver number 1 is U.S. debt and the dollar. We all know the U.S. budget deficit is massive right now, but the key concept here, and this is something every investor needs to fundamentally understand, is no counterparty risk.
No counterparty risk. Let's unpack that, because most of us, we rely on counterparties every single day without even thinking about it.
Right. Think of it like this. If you hold a bond, you are relying on the government's promise to pay you back. The government is your counterparty.
Right.
If you hold a stock, you rely on the company's performance and management.
Yeah.
If you hold cash in a bank account, you rely on the bank not going bust.
I'm always trusting someone else to hold up their end of the deal. If they fail, I lose my money.
Precisely. Gold is totally different. It is the only financial asset that is not someone else's liability. If you hold a physical gold bar, you don't need the government, the bank, or a CEO to do anything. It just is.
It exists outside the system.
Exactly. So as the U.S. debt load gets heavier and people start worrying about the dollar weakening under that immense weight, assets with no counterparty risk become incredibly attractive. It's the ultimate trust no one asset.
So, as trust in institutions goes down, the value of the trustless asset goes up. That makes perfect sense. Now, driver number 2 seems a bit more immediate to me. The Federal Reserve.
Yes. The market is betting heavily on the Fed's next move. Specifically, the data shows an expectation of a massive interest rate cut, about 100 basis points, in the second quarter of 2026.
100 basis points. That is a full percentage point. That's a very aggressive move. But why does that matter for gold? I always thought high interest rates were bad for gold.
They are, because gold doesn't pay you interest. It just sits there in a vault. If you can get a guaranteed 5% interest in a risk-free treasury bond or savings account, gold looks way less attractive.
Right, because I'm losing out on that 5% by holding the gold.
Exactly. That's called the opportunity cost. Why hold a rock when cash pays you 5%?
Make your money work for you.
Right. But if the Fed slashes rates by a full percent, that high yield starts disappearing. Suddenly, the penalty for holding non-yielding assets like gold isn't as painful. It becomes much more competitive against bonds or savings accounts.
So rates go down, the competition for your investment dollars gets weaker, and gold goes up. Simple enough.
Very simple mechanics.
Now, driver number 3. This one I found really interesting because it involves global power dynamics, not just domestic policy. The central banks.
This is the whale in the market. We are seeing a major strategic shift, particularly by the BRICS nations. Brazil, Russia, India, China, South Africa. They are actively trying to de-dollarize.
They want to break up with the U.S. dollar.
Or at least drastically reduce their dependency on it. They've seen that the U.S. can use the dollar as a geopolitical weapon, freezing assets, imposing sanctions. So they are diversifying their reserves. JP Morgan expects central banks could buy a net 800 tons of gold in 2026 alone.
800 tons. That is a massive amount of physical metal just leaving the open market.
And here is the key nuance that most retail investors miss. This is price-insensitive buying.
What does that mean exactly? Price insensitive.
It means they do not care if gold is $2,000 or $5,000. If you or I are buying a gold coin, we look at the price tag. If it's too high, we wait for a dip.
Right, we want a deal.
Central banks aren't buying for profit. They are buying for national security. They are buying for strategic reserves to back their own currencies. When you have a buyer of that size who literally does not care about the price, that puts a tremendous floor under the market.
Because they'll just keep buying regardless.
Exactly. It's very hard for the price to crash when sovereign nations are vacuuming up all the available supply.
That is a very different dynamic than day traders just trying to make a quick buck on Robinhood.
Completely different.
Okay, driver number 4. Now this one is a bit politically charged, but we have to talk about the economics of it impartially. America first tariffs.
Right. We have to strip the politics out completely and just look at the raw math. The source material highlights the impact of President Trump's tariff policies. We are talking about potential tariffs ranging from 10% to 41% on broad international goods, and specifically a 25% tariff on imported trucks.
That's a very significant tax on global trade. What does that actually do to the gold thesis?
It creates friction. When you tax imports heavily, prices go up for everyday consumers. That is purely inflationary. And when investors fear persistent inflation, where do they run?
Gold. It's the classic inflation hedge.
Exactly. But there is a secondary danger here that the models are warning about, and it's called stagflation.
Which is the worst case scenario, right?
Pretty much. Stagflation is when you have high inflation, meaning prices are rising, but you also have slowing economic growth because global trade is being choked off by these tariffs. Stagflation is an absolute nightmare for stocks. It's a nightmare for bonds, but it is absolute rocket fuel for gold. We saw this exact dynamic in the 1970s.
So regardless of whether tariffs protect certain domestic industries or not, the macroeconomic side effect is an environment that gold absolutely loves.
Correct. The uncertainty alone drives the price.
And that leads us right into driver number 5, geopolitics, which honestly feels like the background music to everything right now.
It's the constant drumbeat in the market, ongoing tensions in the Middle East, the protracted conflict in Eastern Europe. It all creates a deep sense of fragility. Investors, and nations for that matter, are looking for financial armor.
Armor.
Yes. When the world feels safe and predictable, you buy tech stocks and risky venture capital. You want growth. When the world feels dangerous and unpredictable, you buy armor. Gold is that armor.
So let's quickly recap this bull case. We have massive national debt. The Fed is projected to cut rates. Central banks are buying price insensitively like crazy. Tariffs are driving inflation fears. And global conflict is everywhere.
It paints a very clear picture.
It sounds like a guaranteed win. It sounds like I should go mortgage my house right now and go all in on gold bars.
And that is exactly where we need to stop, take a breath, and look at the risks.
Right. Time for the reality check, because markets do not just go up in a straight line forever, and I do not want our listeners to lose their shirts chasing a trend.
We need to actively manage the FOMO here, the fear of missing out. If you are hearing these numbers of $7,000 and thinking about using leverage or borrowing money to buy gold on margin, you are walking straight into a trap.
Why? What's the historical precedent for that risk?
Just look at the 2012 to 2013 crash. Gold had a massive run-up after the 2008 financial crisis. Everyone thought the whole system was collapsing and gold was going to the moon.
I remember that. Cash for gold places everywhere.
Exactly. And then what happened? It collapsed. The narrative broke and it dropped something like 30 to 40%. Gold is not a guaranteed straight line up.
So what are the warning signs this time around? If we are sitting here in 2026 and things are looking shaky, what is the bubble burst checklist? The experts in the report gave us a 3 out of 5 rule.
Right. If you see 3 of these 5 things happen simultaneously, the party is likely over and you need to de-risk.
Okay, lay them out for us.
Number 1, central banks suddenly stop buying. If China or Russia announces they are full and they've met their quota, that massive strategic floor we talked about just disappears overnight.
Wow.
Number 2, massive outflows from gold ETFs, exchange-traded funds. That's the institutional hot money leaving the room.
So we need to watch what the big funds are doing, not just the physical buyers.
Exactly. Number 3, prices drop and they do not bounce back. In the industry, we call this weak demand at lower levels.
Meaning no one is buying the dip.
Right. In a healthy bull market, people rush to buy the dip. If the price drops and nobody steps in to buy, the underlying sentiment has completely shifted.
Makes sense. What's number 4?
Physical demand dries up. If regular people just stop buying jewelry and retail coins because the premiums are just way too expensive, you lose a huge, stable chunk of the market.
And finally, number 5.
Number 5 is a macro reversal.
What does that look like in the real world?
It means the narrative flips. The Fed unexpectedly raises rates to fight inflation instead of cutting them. Or, and this would be great for the world but bad for the gold price, geopolitical peace breaks out.
So if we see major peace treaties signed and sudden rate hikes, gold is going to take a massive hit.
Very likely, yes. Now, the probability of all these things happening at once in 2026 is currently viewed by analysts as low, but the risk of using leverage is massive. We could easily see 10% corrections in a single day.
10% in that day.
Yes. And if you are leveraged 3 to 1, a 10% drop wipes out a huge chunk of your capital. It's incredibly dangerous.
That is a terrifying thought for a retail investor. So let's pivot to the solution. We promised our listeners a wealth defense strategy. Let's say you're listening to this and you're thinking, okay, I see the risks, but I want to protect the wealth I have. The million-dollar question. How should an American investor actually allocate their capital in this specific 2026 environment?
This is where we have to put on our capital preservation hats. 2026 is a year of strategy, not just blindingly riding a wave. You have to break your portfolio down by asset class. Let's start with stocks.
Okay.
The research notes point out that stocks aren't currently cheap. The PE ratios, the price-to-earnings multiples, they're historically high.
So do we just avoid the stock market entirely?
No, absolutely not. But you have to be surgical. You don't just buy the whole S&P index blindly. The sources point to sectors that fundamentally improve productivity.
Like what?
AI, digital tech infrastructure, advanced construction, sectors that actually make the broader economy more efficient.
I see. Because even in a high inflation environment, companies that can produce more output with fewer resources will still win out.
Exactly. You want to own the innovators who are immune to some of that inflation drag. Then you have real estate. This is what the analysts call the double profit potential. You get the underlying asset appreciation as property values go up with inflation, plus you get ongoing rental cash flow.
But mortgage rates are a major problem there right now, aren't they?
A huge problem. High borrowing costs are a massive drag on real estate returns. You have to be very, very careful with debt in real estate right now. If you can buy a property with cash, great. But if you have to borrow at 7 or 8% to fund a deal, the math might not actually work out in your favor.
It eats all your profit.
Exactly. And then we get to the star of the show, gold and silver. How do we actually fit them into a balanced wealth-building portfolio?
Right, because it sounds like we shouldn't just put everything in the vault.
You have to fundamentally change how you view gold. You need to differentiate this entirely from your stocks and real estate.
How so?
Stocks and real estate produce cash flow. They give you dividends, they give you rent checks every month. Gold does not. It literally just sits there.
Yeah.
You have to view gold strictly as insurance. It is insurance against financial collapse or currency debasement.
I really like that analogy.
Yeah.
You don't buy car insurance hoping to get into a massive wreck just to make a profit off the claim.
No, you don't.
You buy it so you aren't completely financially ruined if a wreck happens to you.
Precisely. You hold gold hoping you never really need it to go to $7,000. Because I promise you, if gold goes to $7,000, it means the rest of your portfolio, your stocks, your cash in the bank, is probably in deep, deep trouble.
So what is the specific action plan for our listeners? If I have some savings sitting in a checking account, what do I do tomorrow? Do I just go buy a big bar of gold?
First, you use a strategy called dollar cost averaging, or DCA. Do not go out and buy all at once. That is gambling, not investing.
Because you might buy at the absolute peak.
Exactly. If you dump all your cash into gold at $3,000 today and it drops to $2,800 next week, you are going to panic and you will likely sell at a loss.
So slow and steady is the play.
Exactly. Spread your purchases out over months or even quarters. Buy a little bit every single month, regardless of what the price is doing. This smooths out the market volatility. You end up getting a blended average price, and most importantly, you take the human emotion out of the decision.
And how much should we actually hold? If we think it's going to double in value, shouldn't we go fairly heavy, like half our portfolio?
No, emphatically no. The expert recommendation across these reports is the 5 to 15% rule. You should limit your physical gold exposure to 5 to 15% of your total investment portfolio.
That seems really modest, considering all the hype we just talked about.
It is modest, but it is prudent wealth defense. Imagine you put 50% of your life savings in gold. Then geopolitical peace breaks out, the Fed raises rates, and gold drops 30%. You just permanently lost a huge chunk of your wealth.
Right.
But if you have only 10% of your portfolio in gold and gold crashes, it hurts a little. But you're fundamentally fine because your stocks probably went way up on all that good economic news.
And on the flip side, if the economy does collapse,
Then your stocks might tank, but your 10% allocation in gold skyrockets and it offsets those losses. That is exactly why we call it a hedge. It's all about balance and survival.
So let's summarize that structure for everyone. You keep cash and bonds for short-term stability and liquidity. You hold real estate and strategic stocks for long-term growth, and you hold gold strictly for defense.
That is the Fortress portfolio. It's actively designed to survive 2026, whether we get severe inflation, crippling deflation, or economic stagnation.
Yeah.
It is a battle between structural inflation, which is obviously good for gold, and economic reality, which always carries the risk of bubbles popping.
This has been incredibly eye-opening. It really feels like we are standing on the edge of a significant pivotal moment in financial history right now.
We really are. The data doesn't lie. And I think this entire discussion raises one final, highly provocative thought for you, the listener, to take with you today.
Oh, What's that?
We keep talking about gold hitting $7,300. We fixate on that giant number, but I want you to really think about what that actually means.
Okay.
An ounce of gold is just a piece of metal. It doesn't physically change. It doesn't get bigger. It doesn't suddenly get shinier or produce anything.
Right. An ounce is an ounce.
So if gold hits $7,300, you have to ask yourself a terrifying question. Is the gold actually worth more? Or is the money in your pocket just worth that much less?
Wow. That is a haunting thought. We measure all our wealth in US dollars, but if the measuring stick itself is shrinking, the numbers get bigger without us actually getting any richer.
Exactly. That is the great illusion of inflation. And that is exactly why you need a disciplined strategy right now, not just a hope and a prayer.
Well, on that cheerful note,
Yeah.
but seriously, this is all about being informed, not scared. Stay disciplined, actively avoid emotional investing, and stick to the fortress strategy we discussed today.
I couldn't agree more. Don't chase the hype, chase the strategy, protect your downside first.
Excellent advice. Thanks for listening to this deep dive on the 2026 gold shock. We'll catch you on the next one.